Good evening. Today we're going to be presenting on wealth management and crypto. Lightbox has been looking into the space for the past few months, and we would like to share some of our insights on the space as well as some of the companies that we've looked at. And over this presentation, we'll be doing exactly that. Some of the takeaways that we've gotten from looking into the space is that we're seeing an exponential increase in the number of crypto investors as well as cryptocurrencies, which is 3 times higher than 2017, with newer protocols and assets being built every day. The adoption of crypto in India also has rapidly grown, as we are ranked second in adoption globally by Chain Analysis in 2021. India added approximately 20 million users that interacted with cryptocurrencies versus the 24 million new demat accounts that were registered. This is a clear indicator that users are considering crypto to be a strong asset class. With the average user still not knowing what crypto to invest in or how to generate yield on their holdings, we are seeing the rise of wealth management platforms like Mudrex and Coinzack that allow investing in curated or personalized baskets of cryptocurrencies, as well as platforms such as Pillow and Flint that allow you to generate yield via decentralized finance strategies for the users holding crypto. We believe that crypto will continue to remain a complex asset class for the average retail investor, which will create various opportunities for wealth management services to build platforms that allow users to invest, earn, and diversify within the space. Now we're going to begin with where crypto is. After gold, debt, and equities, we can now say that crypto has become an asset class in India, with increasing number of users adopting it. As we mentioned earlier, India is ranked second in crypto adoption in the world based on on-chain retail value transferred, as well as the on-chain volumes on cryptocurrency exchanges across users. We have approximately 7.3% of India's population holding or trading cryptocurrency, and the combined daily trading volume in 2021 across all exchanges is anywhere between $130 million and $190 million. As of January 2022, Indians hold over 5 billion in cryptocurrencies. So now what we want to understand is what these new startups are actually doing. So some of the startups that we looked into was Stader, which is essentially a staking platform that allows users to stake their proof of stake assets with the power of an auto compounding feature over time. We have Pillow that allows you to earn yield on your holdings in Bitcoin and Ethereum and stable coins via DeFi strategies. Some of the strategies that include liquidity providing. And Flint, which again leverages DeFi to earn yield in stable coins through institutional lending as well as DeFi. And last but not least, we have Mudrex, which allows users to invest in customized and curated crypto baskets that allows people to diversify across assets within the space. Now, why is this needed? The methods of generating yield across fiat and cryptocurrencies for users are sort of different. In fiat, we have fixed deposits, debt, stocks, which you can directly invest in. Similarly, in the DeFi space in crypto, we have methods such as staking, borrowing and lending, peer-to-peer, and liquidity providing that allows users to earn yield on their assets. But with crypto being so early, there remains an enormous opportunity for startups to provide these services. Today, to generate yield on your holdings, the lack of knowledge, the poor user experience, unable to dedicate so much time because crypto is a 24/7 globally traded asset, the security risk and the complicated strategies alongside the high volatility make it difficult for users to interact with these platforms, which is why we need wealth management services in this space. They have the knowledge and easy to interact with user interface. They have dedicated research teams that ensure security and insurance of your assets, and they are able to constantly monitor your portfolio while diversifying across strategies to help you earn yield. And now we know that not everyone has the time or the knowledge to generate yield, even in fiat as well as crypto. Hence, we've seen startups in the traditional finance side of things as well as crypto. In traditional finance, you have a small case, you have your Kotak mutual fund, you have Grip, Lendbox that help you get exposure to traditional finance, equities, and debt. Similarly, in the crypto space, we are seeing a rise of startups that allow you easy access to these various strategies in DeFi, such as investing in basket of coins, staking, borrowing and lending peer-to-peer, as well as providing liquidity. But to understand first, we need to get to the crux. What is actually decentralized finance? Decentralized finance is a finance system that is open to everyone, that operates without any intermediaries using blockchain technology. And some of the key characteristics of DeFi that make it so attractive is that it's completely permissionless, pseudonymous, it's non-custodial, which means the assets are not controlled by any third party, but by the user themselves. And these platforms are completely transparent and governed by the users themselves. Whereas in a centralized financial system, we have various banks that interact with each other until the funds reach the end user. Whereas over here, it's completely peer-to-peer. But just like traditional finance, DeFi consists of 7 different types of services that allow users to perform these various activities we see in traditional finance, which have decentralized exchanges, access to credit, stable coins, which is the equivalent of owning fiat. You can get insurance. You have decentralized asset management companies, protocols. You have derivatives trading platforms, as well as wallets that help you hold and trade your crypto assets. However, today we're going to be focusing on how to generate yield through DeFi protocols. One of the few ways is staking, which is earns you a yearly interest of anywhere between 2% to 10%, extremely secure, but low risk as well. Then you have peer-to-peer borrowing and lending, where in which you can earn anywhere between 6 and 15%, which is unsecured but over collateralized, and the risk for there is in between. But the highest risk obviously yields the highest return. In this case, liquidity providing, which is unsecured as you're interacting with smart contract platforms that give you a yearly interest anywhere from 10% to 1,000%. Today, we're going to begin with talking about staking. To understand staking, we need to first understand the difference between how centralized finance institutions issue money. They sort of print the capital when required, which then gets added to the money supply reserve and goes back into the banks where users can borrow, lend, and get access to various financial services. In the crypto world, we have 2 mechanisms of way these blockchains run. We have proof of work, which Bitcoin uses, where it uses high amounts of electricity and computing resources, where a miner is solving puzzles in order to receive block rewards in the form of Bitcoin. Then we have proof of stake, where you have a validator that provides assets as collateral, and that collateral ranges from asset to asset. And he essentially is validating transactions in exchange for a reward. In this case, we can say Ethereum, where he's validating transactions on the Ethereum blockchain and receiving rewards in that form. Proof of stake is the reason why we talk about proof of stake is because it's able to offer faster transactions, lower fees, and requires significantly lower energy than proof of work. As you can see on this table, the process we've explained on how users are required to use high amounts of electricity to solve puzzles versus actually just providing collateral to validate transactions, which allows the fees to be reduced in proof of stake. And in proof of work, the high transaction fees is directly a result of the electricity that it uses. And in the case of earning rewards for the incentive rewards for the user, validating these transactions across both networks, you receive fixed rewards and a portion of the fee rewards. Whereas in staking, you receive a portion of the fee rewards, but it's the user's incentive to provide you with a tip in order to get their transaction processed. Some of the assets that we've seen are in proof of work is Bitcoin and Ethereum. However, Ethereum 2.0, which is shifting to a proof of stake model along with the way Polygon, Solana, as well as Terra work, is what we are seeing. And we are seeing this shift as an increasing number of new protocols are switching to using the proof of stake mechanism. In 2019, proof of stake was only 5% of the total crypto market cap. Whereas today, in October 21, it has reached 15% and is expected to reach 50% over the next 4 to 5 years. Recently, Mike Collier, the CEO of Foundry, which is one of the world's largest mining pools, said he thinks 2021 was the year of mining and that 2022 is going to be the year of staking, which is a clear indication of more and more assets using the proof of stake mechanism. Now, in proof of stake, we talk about something providing collateral. That's known as staking. What is staking? Staking is the act of pledging your crypto assets to a proof of stake protocol, which keeps the blockchain secure, as well as you're able to earn rewards for processing transactions. Within that, we have 2 different participants. We have the validator that's connected directly to the network to validate these transactions. However, due to the high amount of collateral required by the validator, the barriers to entry are slightly high there. Whereas then comes the delegator, where you have platforms that allow you to delegate the small portions of the assets that you hold in order to receive a percentage of the rewards the validator earns. This completely distributes ownership amongst the validator as well as various users that want to participate in the network. And after this, we are now seeing a rise of something called as liquid stake, concept that solve for the liquidity on the token that has been staked on the platform. In the previous slide, we spoke about staking. In that, we mentioned that when you put up that collateral or when you delegate your assets, it gets locked up for a certain period of time, which is why this solution is needed. In staking, the user deposits the asset same as the previous, as we discussed. Whereas in this case, he is issued a tokenized version of what he has staked. It's essentially a sort of derivative which can then be transferred, stored, and restaked or traded as one would a regular crypto. And this allows users to utilize that liquidity to earn additional yield, which we will talk about now. This synthetic asset that we talked about was a stake asset that is further used to generate 4 times additional yield for the user. Hence, using that token derivative, people are able to actually put their crypto assets to work and earn further yield. However, the issue comes is when you're deciding where to stake your assets, whether it be through the traditional format or through liquid staking. Similar to how an average user would do due diligence on investing in stocks or fixed deposits when looking at a bank, we now have users that look at similar questions when looking where to stake their assets. Factors that take into account to choose a secure validator that can prove to be difficult for the average user. And some of these factors include what the uptime rates are for the validator, what the number of transactions the validator has processed into a number of blocks, how long the validator has been actively staking for, and the success rate of the validator. Now, some of these questions you might wonder why is needed is because you are required to understand whether it is secure or not to stake your assets, as well as if those assets will not be lost if the validator has process/transactions. Today, we are seeing a platform in staking. We're seeing a platform as Stader that aggregates trusted validators on their platform to allow users to liquid stake their tokens. Users can stake on Stader across different proof of stake cryptocurrencies, which is like Luna, Solana, as well as Ethereum. And not only that, they get to choose the validator that they would like to stake their crypto, giving them the option of how security and looking at these various factors, taking into account these various factors. And Stader provides these key statistics on a very easy to use platform. Today, Stader has 15,000 unique wallets with over $500 million staked on the platform, recently valued at $450 million. Now we ask ourselves the question is, how does Stader as a platform as well earn money? They are able to take a commission on rewards from the user, as well as take a commission on the rewards from the liquid staking that they provide the users with. And at the same time, for onboarding secure validators, they get a percentage of what the validators make. Hence, they're able to capitalize on every part of the user as well as the validators' experience on their platform. This has seen an exponential growth, as today we are seeing over 260 yield-bearing assets in the that use the proof of stake mechanism, with the average interest rate of over 19%. And some of the popular ones that we've seen are Solana, Ethereum 2.0, Polkadot, Binance Chain, as well as Polygon. Now that we've spoken about staking and the way users can generate yield through just holding these assets, we talk about another mechanism known as liquidity providing. To get into liquidity providing, we first need to understand how decentralized exchanges work. These exchanges are completely transparent and are operated by the users themselves. And they use something known as the automated market maker algorithm that allows digital assets to be traded automatically by using liquidity pools. In exchanges, we have the order book, which matches buyers and sellers. In this case, you have one side of users that provide liquidity in the form of token pairs. In this case, we can talk about Ethereum as well as USDC, which is the stable coin, that allows traders to swap between these assets in exchange for paying a fee. And the fee goes directly to the pool, to the liquidity provider that's provided within that pool. And it's very clear, as when you operate with these platforms, that when traders are trading, it's very clear that they have to pay a fee, and that fee gets received by the liquidity provider. An example would be on Uniswap, a user adds a pair of tokens into the pool and can earn rewards in the same token. In this case, providing in the form of Ethereum and USDC in the stablecoin across different trading fee rates, and is able to deposit for a certain percentage of the fee. Now, we had discussed earlier about how liquid staking assets can be used to earn additional yield. The next step is that, as compared to liquidity providing, there's something known as liquidity mining, which allows users to take their stake token and deposit them in a pool to earn rewards in different tokens, which leads to higher returns. In this case, we show an example where users have staked their assets in Lido Finance, which is another liquid staking platform, use that staked derivative asset that they've received in exchange to go and provide liquidity within these decentralized exchange pools and allow for users to trade between these assets. This is an example of what wealth management firms will do to generate returns for their users. Now to the question is that how big are these decentralized exchanges? We've seen these numbers are specific to Uniswap, where we've seen the transaction volume in the fourth quarter of 2021 reach over $200 billion, where the liquidity provided across these pools have reached 7.1 billion in that one quarter itself. And we're seeing growth over the past year, as well as in the number of users that are using these platforms. So now, interacting with these platforms gets a little complicated and difficult as to how to provide liquidity, how to trade, or how to be able to earn yield securely. Hence, now we have startups such as Pillow, a digital asset management platform that generates yield for the user by interacting with these various DeFi protocols. Pillow is able to generate yield through a few mechanisms. One is liquidity providing on these exchanges, the concept that we discussed earlier, as well as using the stake derivative to earn yield and over collateralized borrowing. They're able to consumerize yield generation in DeFi by making it accessible, safe, and providing a better user experience to build trust with the average crypto investor that might not know or might not trust some of these platforms. And the way Pillow is able to generate return is that they promise 18% to the user. However, interacting with some of these platforms, as we spoke about earlier, yields to higher returns such as 24% and above. This is the way Pillow is able to generate yield through some of this mechanism. Then we have another mechanism known as simply borrowing and lending, which is completely peer-to-peer. In DeFi, the users become the lenders and borrowers. However, the important part is the users maintain full custody of their assets as their wallet is linked to the platforms they use. Some of the platforms that we look at is MakerDAO, Aave, Compound. And all of these platforms are built on smart contracts that run on the Ethereum blockchain or another such as proof of stake blockchain, where borrower and lender interact directly with each other. In this case, today we're going to be talking about Compound. Compound allows borrowing and lending across 16 different cryptocurrencies and has an algorithm that adjusts the APY, the interest rates that users can earn via lending, depending on the demand and supply of the underlying asset. In this case, you have Ethereum, you have stable coins such as Tether, USDC, DAI, as well as a platform known as Chainlink. Now, people like borrowing and lending on the blockchain. However, how does this work? Compound has lending and borrowing markets where the API fluctuates, like we mentioned earlier, according to the algorithm. In this case, from a borrowing perspective, the platform only allows over collateralized borrowing due to the nature of the asset being extremely volatile. So a user can borrow up to 75% of the collateral depending on the restrictions that each asset provides. From the lending perspective, every time a user deposits their tokens on the platform, they receive C tokens that represent the deposit in order to claim it whenever they plan on withdrawing what they've lent. And along with that, they receive the accumulated interest they have earned over the period of time. Now, to say, again, interacting with some of these platforms and monitoring these strategies across assets becomes a little complicated, where we have Flint come in, which is a digital asset management platform similar to Pillow. However, their investment strategies to earn yield are slightly different. They use institutional lending as well as DeFi protocols to over-collateralize lend in order to provide their users with a yield on their stablecoin holdings. Again, talking about the consumerization of yield generation through some of these platforms, providing an easy onboarding, making it quick for the user, and actually providing security by vetting the smart contract platforms they interact with. Similar to Pillow, they are able to generate an additional yield of over 13%, from which that's how they make money. And 13% is then passed on to the user. Compound, as a platform, has over 7 billion in total value circulating either on the borrowing and lending side within the platform as of Jan 2022, with over 300,000 unique users that are borrowing and lending at any given point of time over the past year. This explains how big the platform itself is and the number of users that are interacting with it. Now that we've spoken about these concepts and we have platforms that allow you to earn and generate yield on your holdings, you have platforms that allow you to invest in a basket of cryptocurrencies, such as Mudrex. Similar to Small Case, Mudrex is a platform that allows users to invest in 3 different products. They have preset coin baskets that allow you to invest in curated coin baskets, such as crypto blue chip or like the NFT, which gives you exposure to these different verticals within crypto. Then you have something known as risk-oriented investing, as everyone's risk appetite is slightly different. They have mints that allow users to invest anywhere from a low risk mint to a high risk mint. And not only that, they allow traders who have created automated algorithms to raise capital via the retail user. Retail users can invest in algorithms that traders have created as they believe that they are able to generate a certain amount of return and get exposure to crypto as an asset class. Mudrex has seen great traction over the past few years, where we have over 100,000 investors. They've crossed $10 million in AUM. They've seen $3 billion worth of trading volume on the back end of their platform, and they're spread globally as crypto is built for the world. They make money by charging a monthly fee of 1% on invested capital for the user, whether it be on the algorithm side or the coin basket side, or whether it even be in the risk-oriented algorithm they've created. This allows to give the end user exposure to the asset, as well as invest in individuals who know the space better than they do. Going back to what we've learned from this space, like we said, there's an exponential increase in the number of in crypto investors, as well as the number of cryptocurrencies, which makes it sort of confusing and difficult for the average retail user to interact, which is why we have these platforms that help make it easier. Alongside the adoption increase, this tells us that more users want to get exposure to this asset. Making it simple is what these platforms are helped to. And with the average user still not knowing how to interact with the complex platforms or the complex strategies to earn yield, making it easier is why we believe that, which is why we believe that crypto, being a complex asset class, will be ample amount of opportunities for wealth management services to build platforms that allow users to get exposure to this space in some way or the other. Thank you.